All right, let's talk about Kalpataru projects. We've got the management waiting by very patiently for us while we had that fantastic conversation. But the stock is at the high point of the day, 3.2% higher, and we will go across to the management in just a bit. But let's first go to Parth to set up the conversation for us. Parth.
So strong set of numbers from Kalpataru projects. They achieved the highest ever Q1 levels of both revenue and EBITDA as well. They have a very strong order momentum going on with year-to-date order inflow standing at 15,000 crores. Also, their order book has reached the all-time high level of 66,607 crores as well. If you look more towards the inflow data, then they have got new orders worth 876 crores till date in Q2 FY27. Their year-to-date FY27 order inflows are at 7,668 crores, and further L1 orders which are favorably placed are standing at 7,300 crores as well. If you look at the segments, then T&D segment has the highest share of the order book at 44%. International orders are 39% of the order book and 31% of the year-to-date order inflows as well. So really strong numbers and very strong order momentum for Kalpataru projects in Q1 and continuing into Q2 as well.
All right. Parth, thanks so much for setting that up for us. We were joined by Amit Upalenchwar, who is Director at Kalpataru Projects International. Thank you so much, Amit, for taking the time, and thanks for waiting by. You've been waiting for a few minutes, and we appreciate your time. Talk to us about what worked in the first quarter, because it seems like a few factors have worked in your favor. The margins have actually improved to close to that 9% level, and that's had a bearing on the bottom line as well.
So, for us, it's been a last couple of years that is culminating into a lot of levers that is driving our profitability as both at EBITDA and PBT levels. So I think, the engineering excellence is adding a couple of bips. We've opened a large center of excellence. We've been able to take orders in markets where the competition is more rational. So, for example, our Sweden subsidiary, our LMG, is doing really well in terms of margin profile. We've had a, 18% growth there at PBT levels. Our oil and gas segment is doing really well. We've entered into the highly lucrative material handling system over the last 2 years, which has also helped us increase our margin profile. These projects are also large in value from a unit perspective, and hence so we are getting revenue as well as profitability boost from the segments that we've entered over the last 2 to 3 years.
Amit, just speaking about that, so you're saying that your geographical mix improving has had a bearing on margins. That's work that you've done over the last couple of years. At this juncture, international orders accounting for nearly 40% of the order book. Does that more or less remain the contribution going forward, or do you see that going up even further? One. And two, if you can give me a sense of what the margin profile is for this international order book.
So, so answering your first question first, generally we've been in the range of 50-50 is where our ideal scenario is between India and overseas. However, it's obviously the project mix and sectoral mix does keep changing, but we are happy maintaining a 50-50 sort of exposure global as well as within India. For our oil and gas business, our margins tend to be, in double digit at a PBT level. And at the other segments as well, overseas transmission projects in some of the geographies get us that kind of numbers. So as an overall level, we are able to balance our PBT, at 6.6%, which I think at a industry level in EPC business today is one of the highest. And I think this diversified balance sheet is really helping us get these numbers because, one sector or the other is always booming.
Okay. And on oil and gas specifically, Amit, the point is, and I was looking at another company in the pipe space that plays in the international market in certain pockets in that West Asia region as well. And seemingly, there's a lot of interest in exploration and in increasing production of oil. I'm wondering whether you have any visibility on the order pipeline for your business there, and whether you could see a significant ramp up in FY27 and beyond.
So, technically speaking, there are two major mega shifts happening in the oil and gas space. So whilst you're absolutely right, there is an increased emphasis on producing more oil, and hence new wells are being, made and trying to extract oil there and gas. There is also a massive shift happening in the way the supply chain of oil is moving. So, for example, on the downstream side, people are trying to put new pipelines where the exposure to certain routes for shipment are not relied upon heavily. So both of these present an opportunity for us in the oil and gas space because, as you know, we are present both in the upstream, midstream, and downstream space over the years. So we've, sort of pivoted from not just being a pipeline company and now have moved into process plants as well. So over the next 2 to 3, 4 years, I see tremendous opportunity for us, not just because of the West Asia crisis, but also because of the oil prices being elevated, which justifies capex for the oil companies at this time.
Sorry, just okay. Please go ahead. I'll come back. Okay, no, okay. I just wanted to ask Amit. This is fascinating, right? So, at a time when your T&D is still 44% of the book, you're seeing interest in your oil and gas business, and so therefore, on a blended basis, what is the kind of intake that you're anticipating in FY27? Already in the second quarter, you've had inflows of as much as 876 or close to 900 crore rupees in the way of new orders.
So, for the whole year, we had guided close to 30,000 crores of order booking this year. And including L1s, we're around 15,000. But in Q3, Q4, we expect 1 or 2 orders coming from our oil and gas business from overseas. And that's why we had factored in and planned for a 30,000 crore of order book. Hopefully, Q3, Q4, we'll see, anywhere between, 3 to 4,000 crores of oil and gas order come in. And that's what we are hoping for.
So, Amit, good morning. This is Hiral on this side.
Good morning.
My question is, you're talking about the oil and gas order book. Let's talk about the overall order book as well. I think it's at an all-time high, 66,600 odd crores, if I'm not mistaken. How much of this in totality will be executable over the next 12 to 18 months? And what's the revenue visibility is this providing you for FY27 and FY28?
So, our typical order cycle is between 2.5, 3 to 4 years. And given the fact that we are at 66,000 and we've been growing if you see our last 5 years growth story, we've grown at around 20-25% CAGR. And we are expecting to have 10 to 15% thereabouts growth for the next 2 to 3 years. So I think we have a good order visibility of 2.5 years, at least given at 66,000 crores. So we put ourselves in a very, very good situation. Our balance sheet has been at an all-time best. Our interest cost as a percentage of revenue has dropped to 1.3, which pretty much makes us a debt-free organization in the EPC space. And because of that, there are multiple levers that are kicking in. Our ESG score has jumped to 64, which puts us as number 1 EPC company in India and 95 percentile in the top 300 organizations globally. So these all headwinds, given that we've got a 2.5 to 3 years look ahead in terms of order book, puts us in a strong position today.
Okay. The other thing, Amit, I want to talk to you about is the other 2 segments. T&D, one of the strongest growth drivers as well. So how much of the opportunity that you're sitting on still remains untapped if you talk about what is available in terms of domestic markets? And 2, the water business revenue has declined this quarter. So what has caused the slowdown and when do you expect that to normalize?
So to first T&D, we see, on an India basis, at least 1.5 to 2 lakh crores of opportunity every year for the next 4 to 5 years in the domestic market. And given the fact that, we are amongst the few companies which are in the HVDC segment, etc., in T&D and very large, substation spaces, it gives us a good visibility going forward. So far as water is concerned, over the last 2 or 3 years, everybody is aware there have been problems in terms of collections from JJM projects. We are no different to that. And consciously, we've sort of avoided state projects for water and have been over the last 2 years trying to pivot to international markets. We've got our first order in UAE a few months back, and we are now bidding for large projects in the desal space as well as the high-tech water space, which whether it's membranes and transportation networks, etc., in the Middle East. And so over the next 1 to 2 years, the idea is to move our water segment, and hence you'd see in the next 12 months that our revenue starts upticking as well, and things start normalizing as we take our water overseas.
Okay. So within these segments, if you have to look at FY27 and 28, which businesses will contribute the largest incremental revenue then?
So FY27 will still be the year of TND, oil and gas, and our, as we call it, BNF segment, which also covers material handling. I think these three segments are going to drive FY27 and early part of FY28. And hopefully towards the Q3, Q4 of FY28, the water segment joins the rally as well and starts contributing significantly to the rise of both revenue as well as PBT.
Last question, quick one. Commodity prices, how insulated is your order book from the commodity inflation and the input cost swings that we are seeing right now?
So most of our commodities other than steel are already hedged. We've created some headroom within our balance sheet for the fluctuation in steel prices. But for the moment, I don't see that as a risk to our order book in the current time.
Got it. All right, Amit. Thank you so much for speaking to us. Always a pleasure. In fact, as we speak to the management, the stock is at the day's highest levels as we speak. Nearly a 5% up move coming in there. And it seems, if you see the kind of momentum that the stock has and the valuations, fairly undervalued versus what the potential looks like from here on as well. But moving on.